All right, welcome everyone. Episode 25.
Welcome back. Quarter of a century
of the Wide Lens podcast. Matt Rigby here's with me. We're covering the latest topics in financial markets, and we're recording this on the 29th of July. This is a recession special podcast.
Oh, are we there yet? See the kids in the back of the car.
And Mum and Dad yelled, "Yes, we are."
Yes,
well,
finally.
We're going to cover that,
Maybe.
and we're going to cover a whole lot more topics today. Let's get straight into Matt's Mark a Minute. That will hopefully not be 15 minutes today.
Depends if you can keep out of it. All right.
I'll try and stay out of it. Let's go.
Okay, let's go. The ASX, the last week, up about 1.5% year to date, down around 9.5%. So we're slowly clawing that back. Sezzle, which I paid out on a little bit last week, up a lazy 300%.
We got to stop.
300% over the last week.
We got to stop. I didn't hit record on this.
What are you doing, man? All right, I thought you were celebrating.
No. Sorry, man. We're recording. Okay. Riverside is recording now.
Is that recording?
Yeah, these are all recording, but it's Riverside because then they can't get.
Oh, okay. All right.
Fucking hell.
Let's do it again.
Take two.
Done.
Welcome everyone to the Wide Lens podcast.
We're back.
Episode number 25.
Quarter of a century. We're a quarter of the way there.
It's perpetual. I've got Matt Rigby here. We're going to cover the latest topics in financial markets, and we are recording this on Friday, the 29th of July. And today is a recession special podcast. Are we there yet?
Kids, back of the car, you can picture it driving down the road. Are we there yet? Well, maybe we are.
Maybe we're not.
Who the
Let's.
hell knows?
We'll talk about that and a whole lot more. But let's get straight into Matt's Mark a Minute.
Alrighty. Aussie market, ASX 300 for the last week, up about 1.5%. Still down 9.5% year to date. Slowly clawing that back. We're getting there. Sezzle. So I gave a little curry to Sezzle last week. It's up 300%. No, that's not a typo. 300% over the last week. Zip, who some people may or may not own, up 96% last week. That's on the back of the week before being 40%. Having a good run. Not quite back to $11, Rob, but we're getting there.
I think it was like 11. It was more than $11. But anyway, let's move on.
Zip shutting down some of their non-profitable money-losing divisions. So that's certainly helping.
Good strategy.
Yeah, it's solid, right? Macquarie up 2.6%, out with yet another record profit.
Wow.
4.7 billion.
Huge.
Up 56% from 2021. Their 53rd consecutive year of profitability.
Wow.
What a great business. Kogan up 49% on the back of better than expected performance. Sales year to date expected to be about up 1%. They're expecting 1% growth. Market was expecting flat. Flight Centre, solid business, down 2.3. They were up initially, announcing better or an upgraded guidance for 22.
Travel?
Market travel, mate, everyone's flying. Everyone except me. You're flying. You're everywhere.
I'm flying.
You're a busy man. They were up initially, gave it back a little bit, but better earnings. And Westpac up 3%, threatening to cut lending to oil, gas, and cement businesses, which I thought was interesting.
ESG.
ESG. I don't know. We'll get into that another time. The Nasdaq up 1% for the week, down 23 year to date. Still, Refinitiv data was working this morning. So 53 stocks.
Thanks, guys.
53 stocks down more than 20% year to date. So 53% and 18 in positive territory. The S&P 500 up just under 2% for the week, down 15 year to date. So there's 116 or 23% in positive territory, and 194 or 39% down 20%, around 300 down 10%. Still in the middle of US earnings season and probably really ramped up this week. There's a whole bunch of companies. I'll try and rip through them. So Visa down about 3%, Coke up about 4%, McDonald's down, up around 4%. These all beat, sorry. Etsy up 9%, Chipotle smashing it up about 12%. Slightly lower revenue, but much stronger profitability. And in fact, their food costs as a percentage of sales are falling.
Wow, that's how much sales are
So
increasing.
that's how much their pricing power is. So they're just jacking prices up. Crazy. 3M up 4%, General Electric down
Was
up about
Chipotle around
7%.
when you were in the US?
Yeah, man.
Did you?
So good.
Is it good?
Yeah.
Is it comparable to anything here, like a Mad Max, Guzman and Gomez?
Guzmani. So the dude who started Guzmani lived in New York, loved Chipotle. I believe this is the story I read. Came back here, nothing was like it, so modeled it off.
Right.
Chipotle. I'm going to say Chipotle's better, but far out, it's good.
Okay.
Really good. Where was it?
Sales increasing their pricing power, Chipotle. That's how strong it is.
Yeah, absolutely. So anyway, on with earnings. 3M up 4%, General Electric up about 7%. Apple came out with earnings this morning, up about 1%. Aftermarket, they're up 3%. I'll get into that in a little bit. Amazon down 2%, but announced aftermarket and up 13.5% aftermarket for a 1 point something big $1 trillion business. MasterCard up 1.2, UPS down about 0.2. So they all beat. So companies that missed, Snap. Last week, I probably misled everyone, if anyone was listening. I think I said they did well. Man, not so much. The market disagreed. So their revenue increased slightly, but their earnings got walloped. With one analyst saying that the cash bonfire at Snap shows no signs of abating. That's not a good thing. They're down 13% this week. I think they were down about 30% after they announced the next morning. So they're in all sorts of trouble. Free cash flow is just massively negative there. Twitter up about 5%. They missed. Microsoft up 4%. They missed. Google up, or Apple, Alphabet. No, what are they? Alphabet. Up 2.5%. They missed. Strong ad sales. Just reminding everyone that they're not Twitter or Snap.
What does that mean?
They have still attracting new clients to ad spend, basically. That's what it was. Best Buy down about 1%. Meta up about 7%, although first ever revenue drop. And I think up 7%. I need to check that. Maybe that's not right. And Intel down about 1.6%. Do you want to check that for me?
Yeah, I'll have a quick look.
So I think they dropped a bit last night.
Maybe down 5.
There you go. Last night or week for the week?
No, last night.
Yeah, okay.
Yesterday. They're down 5.22%.
Okay, there you go. Market not happy. First ever revenue drop for them, which is notable, I think. And Zuckerberg didn't come out and paint a particularly great picture. I think he said, we're in the middle of it and it might not get better for a little bit. So,
well, don't you think the market priced that in some months ago?
Well, they should have.
Yeah, I mean, they got clobbered by like 33%.
Yeah. Interestingly, user growth, user engagement increased for Meta. So that was interesting.
Yeah, they fell 31.83% earlier in February.
Yeah, that's right. They got belted. That was when their first user engagement drop, I think.
Yep.
Or user drop.
That's right.
Just a little bit more on earnings. Just a couple of interesting bits here. So Apple, $85 billion in the quarter. That's what they generated. 40 from phone sales, 19 from services, which is interesting. Wasn't that long ago that was 3 or 4 billion. Other products, 8 billion, Macs 7 and iPad 7. Microsoft, something interesting for you, Rob. So their fourth quarter revenue, $52 billion. Okay. Their cloud annualized revenue, $100 billion. Yeah. 5 years ago, the total company's revenue, $97 billion. How crazy is that?
That's crazy. It's insane.
Mental.
It's actually insane. And who knows what the Netflix partnership's going to do for later on this year.
Maybe acquisition, who knows. All right, Visa, their CEO came out and said, based on our numbers, we haven't seen any evidence of consumers pulling back spending in our markets.
What's Visa a sort of a proxy for? Is it the middle class? Is it the...
Oh, that's a good question. I mean, Amex diners. I don't know if anyone uses diners in Australia anymore. In the US, they certainly do. I don't know. I would say they're probably higher net worth. Yeah, probably just the average Joe Blow. Them and MasterCard, and they came out with they missed, but their shares are up.
That goes back to what we've been talking about what the rhetoric is versus what the numbers are telling us. But we'll talk a lot more about that today.
Sorry, MasterCard didn't miss, they beat, same as Visa. So people are still spending. Walmart, they don't report until August, but updated their market outlook with lower guidance. That wasn't great. McDonald's, US sales 3%, non-US sales 13% growth. So that's interesting. Shopify, they were down about 9%, cutting 10% of the workforce. And Toby Lutkick, I think it is. I've messed that up. Anyway, so he's just basically put his hand up and said, look, we expected COVID levels would continue and I got it wrong, which is kind of refreshing to hear.
Pretty brave, isn't it?
CEO to come out and say that. I think he owns a big chunk of the company, so his job's safe. So it's now clear that the bet didn't pay off. What we now see is a mix reverting to roughly where it was pre-COVID, i.e. sales online and in-store. And there's a really interesting chart. I think I've got it later on in the director's cut. We'll chat about it then. But basically sales are kind of reverting back to the long-term trend.
It's not surprising though, is it? With the benefit of hindsight. You kind of sit there and say, oh yeah, that makes sense.
Yeah.
But while you're in the midst of it, you're like,
well, this is how we're all going to do things forever.
The world's changed.
Yeah. Yeah.
I mean, the world's always changing.
And I think online sales will continue to grow as a proportion of total sales, but it's not at that.
We shared a chart a little while ago that showed US online sales have basically come back to pre-pandemic levels.
Yeah, well, I think that's what this chart was showing. Might as well, let's bring it up now. US e-commerce adoption growth rate. So you can see there, it's just reverting back to what the long-term trend is.
Yeah, we've looked at that chart in a previous episode. So yeah, that's
pretty interesting, and I guess it's hard.
What's interesting to me is that obviously the massive spike, but probably more interestingly, it's just sort of this gradual decline down back to the long-term trend rather than this sharp.
Not an equal. Yeah. Yep.
Yeah, cool.
And maybe that's rolling lockdowns or people's lingering concerns. And the last one, PayPal, they're up for about 4% on news that hedge fund and activist manager Elliott Management has taken a undisclosed stake in the business, with expectations that Elliott's going to push for a merger with Pinterest, who, not by coincidence, they also have a 9% stake in. So I think it was earlier this year or late last year.
How does Pinterest make money?
So they sell ads and
Pinterest
kind of
shits me. Like you find
really,
yeah.
God, people love that shit, man.
So it's just
pin
it's
stuff.
one of those things where I don't know. You go on the website, it's like cluttered with crap.
Yeah,
and if you touch anything, like 6 ads pop up, like it's just, and you're like, just close all the windows. Just
I mean, the user engagement's quite high at Pinterest.
What does it? I don't even know what it does.
Well, they just like
photos.
So when we were doing our renovations, we'd be on it going, all right, what can we do under the stairs? What are some ideas?
Yep.
That sort of stuff. Or I mean, that's renovation and homes and sports and all
cooking
sorts of
and
stuff.
a whole bunch of things, right?
Heaps of crap, man. Anyway, so who knows? Some corporate activity potentially there. Emerging markets, last 5 days down 1% year to date, down about 14.5. Oil up about 1% for the last week. And up 28.2 year to date, sitting at about 97.30 US a barrel. And Bitcoin up 7% for the last week, still down 49.5% year to date, sitting at $24,088 US dollars a coin.
I haven't been looking at my Bitcoin holdings either. Although I haven't looked at my share portfolio for a little. I actually looked at it the other day. It's actually jumped quite a bit.
Oh, really?
Yeah. Well, markets are up.
Markets are up. We'll touch on that later. But
we won't.
Yeah, markets have bounced.
All right, let's get into the first topic. Full capitulation. Is opportunity knocking? Is that right? Is opportunity knocking? Or?
Possibly. Yeah. Maybe it's already knocked.
And they've left because no one opened the door. This headline from Bloomberg, which we'll bring up now. Full capitulation could mean opportunity knocking. there's deep negativity over the outlook for the economy, but previous occasions when big fund managers favoured bonds this much turned out to be historically great for stocks. So what I'm going to do is I'll bring this first chart up now, and what this chart is showing, so B of A, their global research team go out and survey fund managers. And you know, this may be for the benefit of listeners, and they ask them a series of questions, and they basically then plot those questions into charts, and you can see what the responses are to some of those questions. And one of those questions, for example, is where fund managers are allocating money.
Yep.
And so what this first one is showing is the equity allocation versus bonds. So where are you allocating money? Stocks versus bonds. And for those who can't see this chart, basically it's a net percentage of asset allocation. Say they are overweight equities versus bonds. There are basically 3 times in the last 21 or 22 years whereby fund managers have been underweight equities, overweight bonds. The first in this chart is back in March of 2009.
Yep.
The second is in May of 2020. And the third is in July of 2022. And you can see what happens subsequently in the previous 2 times that we've seen this over the last 20 or so years. And so what professional money managers and money allocators are doing right now is they are allocating money to government bonds where their real rate of return is well and truly negative, instead of allocating to corporate America. This is US data.
Yep.
Corporate America and American businesses. I've got a few charts here. And so the second chart I want to show is, based on that, how have stocks actually performed every time we've gone through this same process? So this is from Bloomberg. Time to buy stocks was the question mark. The last 2 times bonds were overweighted, stocks enjoyed big rallies. Have a look at the red one in the far left in 2009, when money managers and asset allocators were overweight bonds, underweight stocks. And then you've got the second one in 2020. Interestingly, money managers were overweight bonds well and truly after the market had bottomed.
Just noticed that. It's crazy, right?
And I distinctly remember this when we were running a whole bunch of charts and whatnot and looking at markets during that time. And markets had rallied all around the world. And they went from 5% to 8% to 10%, 15%, and then they clocked the 20% magical bull market number, right? But no one would believe it. It was the bull market that no one believed or no one wanted to believe.
Yeah.
And it's interesting that even after that bounce, that's when money managers switched. For
some, not all.
Sorry,
as we've noticed. Anyway,
yes,
sorry,
that's
keep
true.
going.
And so, why are they doing this? This was an interesting one. I hadn't seen this chart before, so I'll bring this third one up. Is net percentage taking higher than normal risk levels. And so what it's showing is, I'll put a link to the Bloomberg article in the notes as well. You can read it. But basically what B of A is saying is, why are you taking this position? Do you feel like it is less risky or more risky? And the response is,
that's the overweight bond
we're going overweight bonds.
Yep.
Because we think it's less risky, and I'll explain to you later on a little bit more about why.
Yep.
But the last time this was in October of 2008, which wasn't quite perfectly the bottom, but it was pretty damn close. Only 6 months early. But you could see what happened after that fact. Again, we're in that same place in July of 2020. And finally, I'll bring this final chart up. Why are they feeling this way? And this is chart number 3 in the B of A deck. Global profit optimism at all-time lows. They are feeling this way because they're of the view that profits won't improve. And we're just going through earnings season now, and it's a bit of a mixed bag you sort of hear that term, I think, too often enough, mixed bag of results. But if profits aren't improving, and if profits are the thing that driving share prices up, we're going to take a less risky bet. We're going to go to treasuries, right? But again, if we have a look at this, where net percentage, say global profits will improve, negative number means they're not going to improve. September 98, bottom. March 01, bottom. September 08, bottom. April 20, bottom. July 2022. Watch this space to be continued. So with all of that, money managers, I almost feel like are getting sucked into the headlines, or are they foreseeing and predicting what might happen in Q2? What do you think about this?
Yeah, I don't know. It's really interesting. Going back to your first chart, the net percentage overweight equities bonds, the first thing that jumped out at me there is 2001, 2, 3, during the tech wreck, they weren't overweight. That surprises me. But to your latter point, earnings expectations I thought were still pretty reasonable. Maybe the inflation impact is starting to weigh on managers' allocations, or the inflation expectations, or the recession talk. Because you would think naturally earnings take a fall in recession as people start to pull back on spending. So that kind of makes sense. But as we've mentioned a few times before, there's the market's also forward looking. So if we are or are not in recession, maybe the market's already factored that in, and we're starting to see that we'll get out of recession in 6 months' time, and things will start to look better because rates will be lower, and off the market goes. Whereas the bonds allocation is maybe caught up in today, not looking forward. It's pretty interesting. Earnings are the key, and the US earnings season so far has been above expectations, although not always growing. So Apple's earnings were slightly lower, although quite a bit above expectation, lower than the previous quarter, but above expectation. So maybe there is a slow decline in global corporate earnings, but still higher than kind of where the market has repositioned itself to, which will lead to the market bouncing.
It's a game of expectation, isn't it, really?
It's all about
where you anchor yourselves in whatever metric you're looking at.
I mean, you could argue that we've anchored ourselves quite low because the markets have fallen, 15% in the S&P this year. Is that reflective of a 15% fall in earnings, and maybe it's only going to be a I don't know.
Well, some companies,
cyclical fall.
Some companies have.
Yeah, absolutely, but they're not the ones that are driving indexes. Say Amazon and the big boys.
It's just, I mean, we've seen a number of money managers and fund managers, and some that we've invested in the past, whereby even during the pandemic, this survey, we were seeing it in real life with our own money.
Yes. Yeah.
And, that didn't play out well, unfortunately.
No, it didn't.
And so the difficulty, and I was chatting to Deb about it last night, and I said, the market's up about 12% over the last few weeks. And she's like, oh, wow, what happened to, the doom and gloom and everybody selling? And we were just talking about market timing and how difficult it is to try and time purchases, because we were talking about, we're selling a house at the moment, talking about, she said, are we selling a house in a recession? Is that good? And so on and so forth. Yep. And I'm like, well, one moment we're in a recession, the next moment we're not. One moment people are predicting one, the next moment it's done and it's priced in and we're coming out of it now.
Yeah.
It's just so hard to try and pick some of these things.
Yep.
Mate, that is a nice,
beautiful
segue
knock this out
into
of the park.
your topic.
Absolutely. So that is the perfect segue. So let me just bring up this first chart. So this is the S&P 500 for this year, this calendar year. So we're down 15.1%, as I mentioned earlier.
That's after the 12% rise.
What's that?
That's after the 12%
that's
rise
after
over
the
last
rise,
few weeks.
But the last month has been 6%.
Yep.
Up 6.6%. So I guess the point of showing this is just the volatility. We kind of dropped out in January, if you remember. Then it was kind of like we rallied and we dropped out again in March, hitting a new low, rally kind of down into May, June, again. So we've had a lot of down, up, down, like relief rally, fall further, relief rally, fall further. Not saying that we won't get that again. It may well fall, but just that up and down is really difficult to sort of predict, to expect. It's rattling for investors. So this next chart I wanted to bring up is the trailing 1 year S&P 500 average return, and we've brought this up before. And the subsequent returns based on if you were fully invested, if you missed the best 10 days, 20 days, etc. And I guess the point here is it's impossible, based on that last chart, it's really, really difficult to know when we're at that bottom and we're at that high. And if you try and play that game, be it professional or amateur investor, the consequences of getting it wrong are pretty significant. So
look at the missed 10 best days.
Yeah.
Do you know what time frame this is over? It doesn't have the footnotes.
It's a 1 year. So they're looking at, but what data set have they looked at? I'm
Yeah,
not sure.
These are generally run for at least 20, 30 years.
Yeah, something like that.
Can you imagine though you missed the 10 best days? And we've talked about this where the best days follow the worst days.
Yes.
As we've seen.
Yes.
We've talked to clients that were just really like, what do we do? Like,
do we
just
get
hang in there.
Yeah.
And all of a sudden in 6 weeks, the market's up 12%.
Bounces. So what the way to read this chart is, if you're fully invested, your average return over time is 8.8. Let's call it 9%. If you miss the 10 best days, your return is going to be 9.8% lower than if you were fully invested. So not a negative 9%, but 9% off that 9%, if that makes sense. If you miss 20 best days, you're down a quarter, so on and so forth. If you miss the 50 best days, so this is someone that's just panicked, isn't sure what to do, sitting in cash long term, your return is about half of what it would be if you were fully invested, which is a phenomenal difference. I mean, that's huge. So your returns
that's
about
wealth
4.5,
destruction, isn't it? That's how you.
Yeah, I mean and this is without inflation. So you factor inflation in there, say it's 3, you're basically treading water. So there was this other chart that Bespoke brought up, which we'll bring up now, which I thought was absolutely fascinating, because the narrative is always, the markets move or react pretty significantly based on Fed decisions. So if the Fed's going to raise rates, let's just sit back and wait and see what happens, and then we'll get into the market after that. So it's a very specific event-driven kind of thought process. So this chart here is basically showing the intraday movements on the day that the Fed announced and this is for this year. So this is through March, May, and June. So you can see the blue there is March, so that's kind of trading throughout the day. The Fed announces at 2 o'clock. The market falls 2:30, about the low, and then it rallies to be, closing at the high for the day.
Isn't it?
It's fascinating, and not that I would ever advocate for trading, very short period of trading at all.
This is just the average. Like you could have
stocks, going much higher, individual stocks much higher, and not recovering within that. Then you've got June there in green, and the May in the light blue there, and I guess it's just kind of highlighted to me that the market is schizophrenic at times. Like it just doesn't know what it's doing, doesn't know what to expect. These are all fairly big rate rises. The last two have been 75. I think the one before that was 50. So, they're big increases. At the start of this year, we were saying we didn't think rates would go to 3%, official rates. We're getting awfully close in the US anyway. But people were talking about a 0.5% rate rise will kill the market. Well, now we're getting 75, back-to-back 75s, which is, kind of significant. And then the last chart I want to just bring up is, and this is from Jim Reed at Deutsche Bank, who we reference a lot. So this is the cumulative S&P 500 price move during Fed meetings. So the 3-day or the 2-day Fed meeting and the day following. So since 1990 and the move overall. So all days, this is what the market's doing in the light blue color since 1990. So pretty strong. And in that dark blue, and the reason I kind of wanted to show this is during those first 10 years, 1990 through to 2000, the market still did pretty well based on Fed decisions in the Fed meetings.
I don't understand. What does that blue line mean? FOMC window dates cumulative S&P price move.
Yeah, so this is the 3-day. So what they're saying is, if we take a snapshot of the market movement in the 3-day window around Fed meetings, so
during the meeting,
the start of the meeting to the day after the meeting.
Right.
So here's our 3-day window. How's the market reacting around this time period?
Gotcha.
So, and then how does that compare to what the market just does generally?
I get it. Yeah? Okay, gotcha.
So here they are, and you go through periods where the market doesn't really react, periods where the market falls, periods where the market's going up. So the point is,
I see what you
even at a longer time period, we saw that intraday it's really difficult to know what the hell the market's going to do. Over a long period, it's near impossible as well, because you've got periods where the market's up, it's down. It doesn't matter. Over the long period, and this is a 30-year time horizon, the markets do well. This is just short-term noise. It's not something you should be, staking your financial future on, especially when you're many years out from retirement, or you've just retired and you've got 20 odd years of retirement to fund. Basing your decisions on day-to-day movements like this is just crazy. So that was. Sorry, go ahead.
It's almost like I said this to Deb a week or so ago now. I feel like. You never build a house, but there's a saying that says you don't build a house on tomorrow's weather forecast. So you don't design a house based on tomorrow's weather forecast, right?
Yep.
You design a house for, the environment, but also for what you want and what you need.
Mm-hmm.
You want 4 bedrooms, you want double story, you want single story, and so on and so forth. And you kind of cover for the big major risks, right? And I think that sort of it can relate back to investment management, portfolio management. Like, I don't think anybody should be investing for how the economic climate is right now. Like,
no.
In the grand scheme of things, I think it's irrelevant. I mean, maybe if you don't want to sell your house at this point in time, you're going to hold off for 3 months. Okay, maybe if that's the big sort of life decision for you and your family, it's going to then domino affect a whole bunch of things. Fine, that makes a lot of sense. But to look at what's going on in the market now, or the forecast of what's supposed to happen in 3 months' time, and design a game plan around that, it's just
crazy.
Foolish.
I mean, it's pretty simple. Markets go up over time. The longer you're in the market, the higher the probability you are going to make money, and the longer you're in, the more you're going to make. I mean, it's as straightforward and simple as that. And trying to pick these highs and lows and whatever is, honestly, it's pointless.
Taking a leaf out of Warren Buffett's book.
That's it?
Warren Buffett's last
Later?
the annual meeting, the Berkshire Hathaway annual meeting, where he says, wealth management and investing is very simple. He says, but most people overcomplicate it.
Absolutely. We do.
Yeah.
I don't know why, but it's super simple at its core. So there you go. Invest for the long term. Don't time the markets. Probably could have saved ourselves 15 minutes, really, couldn't I?
Am I jumping in with this one now?
Yeah, mate, go for it.
So when everybody hates stocks, it's time to buy stocks. Bespoke had this chart here, which I want to bring up now, the Conference Board stock market bull-bear spread. So basically they take those that are bullish, subtract those that are bearish, and you get a net score. So it's just a spread. So this chart is showing that spread since 1987, and the spread is now at the most negative level in over a decade. So we haven't seen it this bad for over a decade. And you can see it in the late 80s, you can see it in 03, to your point that you mentioned before, and it's typically a peak pessimism, right?
Yeah, absolutely.
We saw it in 08, 09, we saw it in 2012, which I think was that the European debt crisis. What happened in 2012?
Yeah, I think it was.
Remember.
Yep.
I didn't even have kids in 2012.
Wow.
Crazy.
Lifetime ago.
And now here we are today in July of 2022. This is what is going on.
Lower than 2020. Just FYI.
Yeah, I didn't even pick that up.
Significantly.
How interesting that is a global pandemic. The world shuts down. Everything's fine.
And now we're pessimistic.
Have you seen that meme where there's that dog drinking a cup of coffee, and and there's fire around him. The house is burning down.
Oh, really? No, I haven't seen it.
And at the bottom, it just says, everything's fine. So what Bespoke do really, really well, and I'll bring this chart up in a moment, and Matt, you and I love looking at these things, is looking at history And, I was going to say dusting off the cobwebs and whatnot off the history books, but here there's no dust on the history books because we're opening them all the time. No cobwebs. But I think what's important is, you may want to take it with a grain of salt, you may not, but have a look at when we have been here before, how has the market reacted? How has the market responded? And so I'll bring this chart up now, and it's the bull-bear spread. What happens to the S&P 500 when this spread drops below 20? Which, as we've seen 1, 2, 3, 4. This is the 5th time we've seen this since 1987. Oh, there we go. They've already done that for me. There's 5 rows there. I'm counting the chart. Thank you, George at Bespoke. S&P 500 performance, we've got the 31st of October. This is a US date, 1990. This must be very normal for you to read, Matt. Very not so normal for the Aussies. 03, 08 and 2011. You can see what happens in 1 month. There's a 50-50 chance that in 1 month's time, the S&P 500 is up and the median performance is 2.7%.
Sure.
Have a look at 3 months. 100% of the time, historically, the market has been up 3 months following. Mm-hmm. And it's been up
nicely.
I won't say average, it's the median, 9.19%. 6 months, the median rise has been almost 15%. 3 out of the 4 times, 75% of the time. And 1 year later, 75% of the time, 08 was the big one. It was a down further 37% from there. 75% of the time, up 20%. And Bespoke had this, I'll quote, "There's really not a lot to like about current economic trends lately, but if there's any silver lining, it's that history has shown time and time again that what shows up in the headlines today has already played out in the stock market months ago."
Absolutely.
I think that sums it up so well. So where we're sitting now, it is investors, consumers are very bearish. I don't know if you saw this headline. I'll get this one up now as well. Yardeni says S&P 500 has already bottomed, sees no hard landing. So Yardeni says that the index level at 3666 was a bottom in June, and compares that to the intraday low in 2009 of 666. The index fell to 666. It's absolutely mind-boggling. So Yardeni's saying no hard landing. He's called the bottom, which was about 6 weeks ago. So far, so good. The question for you is, what do you think is going to firm up this rally? How do we know that this is not another relief rally?
Real. I think you go back to why the market's down. So it's down because of inflation and interest rates. And I think if you see inflation starting to top out or roll over, then the expectations are that the Fed can slow or pause on rate rises, and then I think naturally you flow on to consumers start to feel better. Maybe wages get a chance to catch up with price increases, and then company profits stay intact, and then we kind of take off from there. And I think, I think it's as simple as that at this point. The risk is outlook statements for company earnings right now, which haven't been too bad in the US. But if companies start coming out to say, we can see earnings are going to start to drop off or sales are falling, then, we could go the other way. But I think it's all about inflation and interest rates right now. What do you think?
Yeah,
do you agree?
I agree with you, and I think we're already seeing that with the way the market responded to the Fed's 75 hike.
It's all positive, and the market's up.
Yeah.
As we saw in that earlier chart.
Powell said in his statement that he feels as though the Fed has done the hard rise they've done that in trying to combat inflation. But I think what the Fed really, and I think that's why they went 75 and not 100, is because there are other economic indicators, especially sentiment, that is literally falling off the face of a cliff. And so I don't think central banks can simply look at what is going on with inflation. I think they need to also. I think they're looking more closely, or they're giving a bit more weight to these other numbers.
Yep.
So I reckon you're right. I reckon the market could have priced in the recession for the year. Who knows? And I think your topic is the next one about the recession, whether we're in a recession or not.
Yep.
But I think the market does an excellent job in trying to find the perfect price at every single point in time. I don't think there's any other way to look at that. The question is that are we going to test new lows from here? I mean, time will tell.
We might.
We might, but if we're starting to get signal that we're not testing these new lows, then Yardeni might be right. We may have seen the bottom for this bear market, and we could rally from here.
Mm-hmm.
Alternatively, we could have a more severe recession or a severe, let me call it an economic downturn in the second half of the year or early next year, akin to that of the tech wreck in the early 2000s, where I feel like this is very similar to that of what we saw in the tech wreck. Everything was looking good. Companies were still reporting. It wasn't until the year after that the backside fell out of the economy.
Yeah. And then you had September 11 in there as well,
and that didn't help.
Didn't help at all.
So look, that's I think markets do a pretty good job in pricing, and if you really want to be contrarian, I guess here's your opportunity.
Yeah, I like the analogy when everyone's on one side of the boat. It kind of makes sense to be on the other, because generally
you just said that, right? When we were up in Cairns, we did some crocodile tours and whatever.
Yeah, you told us this last week. And then you went and ate some of the crocodiles.
No, I'm vegan, man. I didn't eat the crocodiles. The other people went and ate the
crocodiles.
Did. I ate lettuce and drank water. Look, I'm not an expert. I don't know.
Crocodile spotter?
No, but a person that drives a boat.
Oh, okay.
A captain or a captain.
Captain.
The captain of a tinny. But he's observing, right? And he's like, oh, on the right-hand side, there's a ginormous croc. That's Joe. And everyone goes to the right-hand side of the boat, right? But they are the investors. They are the everyday investor. Mm-hmm. And you're the captain driving the tinny. You're like, guys, what the fuck are you doing? And they said, you know what the saying goes, if everyone's on one side of the boat, you know what happens. And then I thought, wow.
Become crocodile food.
You become crocodile food. But that's a really good analogy. And that sort of just came to me now, which is those participants, they don't think about this stuff. They're just like, oh, look over there. Or look, and everyone's just, and you and I, the guy at the back, they're going, guys, what are you doing? just
chill.
Just stay where you are.
Yeah.
Don't do anything.
Yeah. And as I said before, it's pretty simple. It's pretty straightforward.
It is, but it's not.
Term. All right. So, sorry, you done?
I'm never done, but keep going.
I know. Isn't that the truth? All right, let's go. So are we there yet? The kids screaming in the back of the car. US recession. Are we in recession? So last week I referenced this they're not shady, this secretive group.
The stonecutters.
The stonecutters of US people that determine what a recession actually is. So I found the definition, which I thought was really interesting. So the group is called the National Bureau of Economic Research, and so they make the official recession call. That's their job. Tell us when we're in recession. It's usually many months after it started, and often, occasionally, when it's finished, then they go, oh yeah, by the way, we just had a recession. Okay, excellent.
It's actually quite funny, isn't it? When you explain it to me like that.
Yeah. So driving in watching the rearview mirror, right? All right. So they define a recession as a significant decline in economic activity that is spread across the economy and that lasts for more than a few months. And they look at a variety of factors, including labour market, so unemployment,
strong,
consumer and business confidence or spending, industrial production, and incomes, among other things, but they're kind of the key things. So that's what they use to make their determination. So are we in recession is the question. So here we go. We've seen consumer confidence, we've seen that a lot, and that has fallen off the face of the earth, but consumer spending is still pretty strong. I think we saw that a few episodes ago. So spending holding up. Labour market. So I'll bring up this chart now. This is from Bloomberg. So with every recession since the end of World War II, the US unemployment rate was either climbing prior to the declaration of a recession.
Unemployment rate.
Unemployment. So this is the unemployment rate. So it was either climbing prior to the declaration of a recession, or it rose during the period where a recession was declared. So that's not the case this time around. So the first half of 2022, the unemployment rate has fallen from 3.9 to 3.6%. So based on the MBER's metrics, that's a no. We're not in recession, that component. Consumer spending, not in recession. Consumer confidence, in recession. So we're 1 for 3. What else have we got here? And this second chart here from Trading Economics is the consumer confidence numbers. And as you can see, they're kind of falling. No, sorry, sales. Sales are falling. So 1.2% quarter on quarter, 0.6, 0.2%. So they are falling, heading in that direction. And interest rates. So the Fed are raising rates. And this is, I guess, I was putting all this together and this really caught my thought process or my train of thought. So typically interest rates take about 6 months to have an effect. So the Fed started raising rates March, April?
It's the alcohol, right?
March. No, it was March. That's right. So we had our first shot in March. A few more shots since then. It's now starting to impact. But where we've gone from in March to where we are now in terms of the rate, the official rate, if you fast forward 3-4 months from now, the most recent interest rate increase that we've had, and if that continues to play out, i.e. people continue to pull back spending, in 3 months' time, we could be having fairly decent negative quarters of economic growth if that trend plays out. So my point being, we've only just started to see the impacts of the first interest rate rises, and we've already had 2 quarters of negative economic growth. So it wouldn't surprise me if we have 4 quarters of negative growth this year, and that's
But we may not be in a recession.
We may not be in a recession, but that's assuming the Fed has finished raising rates as of earlier this week. I mean, if they could continue raising rates.
I think Powell did say that there's... Yeah,
I was just about to say that. No, go ahead.
No, go for it.
Powell said they've got one focus, and that's inflation. If that means the unemployment rate goes up, so be it, but we've got to get inflation under control.
I think what I was going to say, which is not that, which she said that there's... the expectation for higher rate hikes is not off the table, but there's likelihood of less severe hikes in the future.
Yeah, okay. So they're going to moderate the rate at which they're increasing. Yes. Okay. And then industrial production. So I've just brought up the GDP numbers here, which is from Statista. So we'll just bring this up here, and you can barely see it. Right at the right-hand edge there, we had negative 1.6% in Q1 of economic activity, negative 0.9% of Q2, and they're just those little red markers right at the end there. So we've had 2 quarters of negative growth, and that's not just industrial production, but there's a fair component in there. Consumer spending is also the other part or major component there, imports, exports, etc. So while we're looking at this chart, the other thing that really jumped out at me was just how quickly GDP has turned negative previously. So if we look, we can always go all the way back to the 50s, 60s, but even if we just look, 2008 for the GFC, it started off kind of negative, positive, and negative, and then it just fell. What I would have said then was off the cliff. And then
but you haven't looked
took
at
a little while.
2020
Then 2020 showed me what off the cliff is. It recovered, and it's not unusual to have a negative quarter of GDP. So we've got some in 2010, we've got some there in, I'm going to guess that's like 2011, 12, somewhere in there. It's not unusual. So 2 quarters of negative GDP growth is probably not overly unusual. In terms of, you can have 1, maybe you can have 2 in a row. But if we start to have 3 and 4, then I think you'd start to say, all right, we're absolutely well into recession.
I could be wrong, and I probably am. I think I read somewhere that even though we may, to your point, may not be in the NBER's technical definition of a recession, but I believe, I could be wrong, that we haven't had 2 quarters of negative growth without a recession. So even though that may not be the technical definition of a recession, we've never had a situation whereby we've had the 2 and we haven't had a recession.
That's right. I think I read that too. Bloomberg or
possibly
Statista, someone. That's a really good point. And I guess to the interest rate comment, if rates are still going up and we're only just starting to feel the impact of the first lot of rates, then you would say there's a fairly significant chance that we're going to have. If the next quarter is not negative, then current quarter we're in now, then certainly the one after you would think would be. So we may have 3 in the US, 3 quarters of negative growth this year. We might have 4, but I don't think it's going to stop at 2.
Do you think people are just smarter now and trying to anticipate the impact of certain things? So economically, I feel like people are more informed about economics and central banks and interest rates, and as a consequence of that, naturally you try and protect yourself because you've got, we're just human beings who try and protect ourselves. And so if there are these bad things that are supposed to be happening in the economy, do you reckon people just try and, this is the everyday Joe Blow, right? Tries to protect their financial situation and try and anticipate what something may happen or may not happen. And so for that reason, do you feel like these things become more known and more people, and that's why maybe some of these surveys are coming out the way they're coming out, even though people aren't actually doing anything about it, they're just feeling shit. And people are trying to anticipate. And so it becomes really noisy, really volatile, and maybe short and sharper changes in whether it's economic activity or stock market declines. What do you think about that?
Yeah, no, I think you're right. And I think, we've talked before that confidence, if you start seeing recession in the headlines, you're going to start to pull back a little bit. And if that continually comes up in the headlines, I think you're going to pull back. Consumer confidence falls. And I think confidence leads a lot of that stuff in terms of it's kind of the forecaster.
But if everyone expects it, do you think? I mean, I feel like there's 2 outcomes. You're either going to sort of induce yourself into it, or I just moved a couple of things around.
Yeah, I know.
Hopefully, I'm not confusing you or your train of thought. You either induce yourself into it, because I think you were referencing a couple of different charts on the doc. You either induce yourself into it, or everyone thinks it's that obvious that it doesn't happen. And then once everyone kind of just relaxes about the situation, and then just bang, it just smashes you in the face. Totally unexpected.
Yeah. Look, I think consumers are pulling back, and maybe it's not showing up in the high level numbers because, and I guess the other thing I keep thinking about, I'll finish that thought in a sec. When you look at total dollar spend, I mean, I think inflation kind of masks some of that. You still have to spend, maybe not buying as many goods, but you're still spending the same amount of money. So that is a pullback.
Sure.
Certainly for those, retailers or manufacturers or whatever. So that's certainly part of it. But I think, consumer confidence has absolutely been belted, and I think it will continue to be belted as interest rates go up, and I think people absolutely start to pull back more and more and more. And if we get a negative quarter of GDP growth here in Australia, which we haven't yet, I think people start to panic. Because what do you see on the front page of the newspaper the next day? Recession, negative growth, all that. And it's so
I told my kids today that we're in a recession. They're like, what does that mean?
You're like, don't worry about it. Sit in the back seat. Hey, a couple other really, really quick things. US June pending home sales down 8.6%. Negative 2.1 was expected. Mortgage applications down 1.8 versus, that's for the week, versus negative 6.3 the previous week. So housing is cooling in the US. There's zero doubt about that. And just some other broader economic news, because we don't probably talk about Australia enough. So Aussie inflation came in at 6.1% annualized versus 6.3 expected. core inflation was 4.9 versus 4.7. So the core number's going up faster than expected, but the headline is dropping,
down.
which is that's an interesting. We'll see how that plays out. Retail sales in Australia for June grew at 0.2, again expectations of 0.5, I guess to our comments earlier. And in Russia, just for all the Russians listening out there, they're well and truly in their recession. So the GDP is negative 4% since January, and if you annualize the June number, it's negative 4.9% of annualized. So they are not only in recession, but their recession is getting worse. I don't think anyone in the world, apart from Vlad, is probably surprised by that. He's probably the only person and wouldn't be feeling it.
I wonder if the non-US McDonald's sales is because of what's going on over there.
Non-US.
You talked about McDonald's.
Yes.
Their sales were down at non-US.
Yeah, no, the sales are up.
No,
up
they were
13%.
They were up in the...
up 3% in the US, up 13% outside the US.
What? I thought you said they were down.
No. Did I say down?
Nice.
I'll listen to it next week.
I'm just trying to look at your
$1
numbers.
apology. Yeah, McDonald's.
I don't know where the McDonald's is.
There it is. US sales growth, 3.7,
non-US.
non-13.
Okay. I saw the minus between non and US, but it's just a hyphen.
It's just a little pause.
All right, what do we got? We got director's cuts.
mate.
All right, first thing, Neighbours, cut, done, dead. Did you see this? Finished.
I was out last night and I got a message on my phone, the 10 Now app. Watch the final episode of Neighbours.
Neighbours.
I was like,
Finished.
that's right.
So apparently...
Did you watch it?
I don't watch Neighbours. My parents wouldn't let me watch...
You're offended by that comment.
What?
I don't know. I don't watch Neighbours.
No, because we weren't allowed to watch Home and Away when I was a kid.
Really?
Yeah, because I don't know, there's just stuff going on in Home and Away that my parents didn't agree with.
Scantily clad beachgoers.
But what Bloomberg were reporting was they didn't keep up with like what's going on in the world.
Oh, really?
So in 2018, they featured a gay marriage. Quote, the first transgender cast member came the following year, played an Australian actor and trans rights advocate Georgie Stone, who approached the producer to add her character. Critics rightly argued that these moves to reflect the realities of modern society came way too late. That tardiness helped entrench both at home and abroad a stereotype of Australia as a racist and intolerant nation instead of a place with a deep mix of cultures, religions and identities. I think that's a really good point, isn't it?
Yeah.
What do you think?
That's interesting.
It is. I'm like, why is this thing being cut? I mean, it's been going on for so long. One, I've been surprised that it's gone on for so long, but I was interested to see why it was cut. Have you ever gone past
Maybe it's
Ramsay Street?
Institution.
In Burwood?
I have not, but I remember when I was living in the UK, people were like, "Oh, where are you from?" Like Melbourne. Like, "Oh, Neighbours." I'm like, "Oh my god!" Like
They used to have buses that would, like the Neighbours
tours.
bus would take you there.
Yep.
Second thing from Bloomberg, you'd like this one. Quote, a Tinder swindler victim lost her bid to blame ING for failing to stop her money being transferred to the con man, a Dutch court ruled. The Swedish woman alleged the bank breached its duty of care by not blocking the transfers that she made to a person who then sent the funds to Simon Lviv, the subject of the Netflix documentary. The scam is estimated to have extorted $10 million from women Lviv befriended on dating sites. The Swedish woman was ordered to pay legal costs of 2,356 euros. Like, she hasn't been scammed enough, and then she gets stung with another 2,300 euros. So he served...
How the hell is the bank meant to know? Like, for fuck's sake.
It's so dumb. So I didn't know this. He served 5 months of a 15-month sentence and is now I was going to say a living free man, but he's now living a free man. He's a living free man. What does it even say?
I don't know, mate.
And he's living a free man.
He's now living as a free man.
Mate, this is quote unquote from Bloomberg. Who are these journalists writing these things?
He's out of jail.
He's out of jail.
That's all they needed to write.
But he's still wanted in like Sweden, Norway, Greece. Okay. Yeah, so
he can't travel too far.
No, he's
Isn't he from Israel?
Yes.
Yeah. Okay. I don't know why that matters. It's just
$10 million. Extorted 10. Is that US dollars? Is it like who knows what that even
American,
is?
so probably.
But
US.
you know,
that's he should be living comfortably for all his hard work.
5 months. He serves 5 months for stealing $10 million.
Would you do 5 months for stealing $10 million?
Yeah, but I'd
a
try
month
and
in jail would be hard work.
The other
unless it's like one of those Bernie Madoff type or the Wolf from Wall Street dude. Like, maybe.
So, but the issue is he doesn't have the money because he's just spent it all, right?
Oh yeah, I guess on his.
But see, if you've got the money,
rollers and
that money's, what is it, confiscated? Whatever the word is?
I don't know if they can find it, right?
Come on, how are you gonna?
I don't know. Skase did it for years.
Put it under your mattress.
Maybe. All right, just a quick one on Walmart. So sales guidance was lower, noting that higher prices are causing consumers to buy less, I guess to our comments earlier. So they're cutting prices a la Target, deflationary, possibly. Walmart, Target, probably the two biggest bricks and mortar retailers in the States. I can't think who'd be bigger. So they're cutting prices, and if they cut prices, someone else is going to have to follow to compete. So that's interesting. But what was interesting is they're seeing a reduction in non-food sales, not food sales.
Yeah.
Which I guess is not surprising. You still have to eat, right? So you prioritize the basics over whatever junk they've got on the shelves, a cushion or whatever the hell it is. Anyway, so that was just interesting. But
don't you think that's kind of too late? So where consumers are at right now. So yes, consumers are still spending, but if it's like saying properties going down. It's like, well, different properties go up and different properties go down. So what are you actually talking about? So when you talk about consumer spending, to your point, food could still be going up, but apparel. How many, I don't know, puffer jackets do you need? Like 9? Yeah. No, you probably just need 1, right?
Yep.
And so I don't know how, I think that's more discretionary. Even if prices come down, I don't know if people are actually going to be buying.
So your question is, even though they're reducing prices, that may not stimulate demand.
I agree.
For that.
Yeah, that's what I think.
I think you're right. That's a good point. We'll find out. They'll just have to keep cutting prices.
Yeah, I mean, it gets to...
And then do they stop ordering other stuff?
They've already stopped ordering.
And,
they've already stopped ordering. They've already stopped ordering.
Yeah. All right.
So off to TK Maxx to buy even better bargains. Last year's summer gear. Tips and recommendations. What have you got for us today?
So I've got a recommendation which none of you will be able to go and see. So it's almost pointless, but... I think it's still worth a shout out. Well, I'll broaden it. So last night we went to the Emmaus College school musical, which was Anastasia, which I'm sure you're all over, the Russian royal family taken over by the Red Army or killed by the Red Army, and so on and so forth.
You're more over it than I am.
And I was quite honestly blown away by the level of talent. Like just the two female leads, well, the four leads.
Which grade or which year?
Well, it was the
whole school? The
whole school. So I'm going to assume that the lead, and I don't know her name, but I would absolutely give her a shout out because she was phenomenal. Anastasia. I'd say she was like year 11 or 12.
Right, okay, sure.
I don't know. Anyway, her voice was like, holy shit. Just amazing. Like,
yeah, right.
You'd have to listen to it. And
was it at the school?
No, it was at Monash Clayton. That's the big Monash campus. I think it's Clayton, yeah, which is just ridiculously large. So we're sitting there and she started singing and my wife and I both turned to each other and went, holy shit. Like, she was incredible.
Yeah,
like,
right.
And we were walking out and I was saying to the boys, we were just talking about it. And they're like, could she be professional? I was like, oh my God, yeah. Like, I don't see how. Like, I couldn't tell the difference. She was amazing. And the other lead, which was a female lead, which was her grandmother, amazing voice. The two guys that were in there, really, really good. Could really belt out a tune. Just was blown away. So I guess my recommendation is high school musicals are going to be a hell of a lot better than you expect. Like, I was just absolutely, and I'm still a bit like, did I really hear that?
Do they record them and stuff?
So they do record them. You could probably buy it. But great musical. The production, I mean, the level that these kids go to, like the backdrop and the stage, it's just amazing. I mean, they really put a shitload of work into it. And you'd say, I mean, if you didn't know it was a high school musical, you'd probably go, oh, that was a professional job. Like it was a really well put together performance. So High School Musicals, if you get a chance to go, give it a shot. Yeah, it's probably better than what you think.
Their lead's parents probably would have been pretty stoked. Pretty chuffed walking out with
Holy cow.
out of the auditorium.
Yeah, I mean, they got a standing ovation.
Wow.
The crowd were just going
Yeah, wow.
mental. Like, she was exceptional.
Yeah.
I need to know her name because I'm sure we'll hear her again in the future at some, I don't know, whatever.
It's
Princess
funny
Theatre.
you talk about like detail. I remember I was listening to something that was talking about Walt Disney, and when they were putting the theme parks together, the design team replicated this bird or these birds or something, and they said, you know, they were showing Walt, and they said, look, it's got everything. It's got, you know, the feathers, it's got the eyes, it's got the feet, the size. No one can tell the difference. And Walt said, I don't like it. They said, but what do you mean you don't like it? It's the perfect replica of this bird. And he said, the designers also made it sort of breathe, so it kind of does this thing.
Yeah.
Said it even breathes. Walt said, because it's not real. People know that it's not real, and it doesn't have that soul and that love of that realness.
Yeah, okay.
And so, like your comment about the detail of whether that was that good or not that good, like I get a sense from you that there was just that much poured into this thing that you could feel it from the performance.
Absolutely. I mean, it was great. And, you know, I'd been to a few kind of high school, primary school musicals, and clearly they're not going to be as good. They don't have the budget and so on and so forth. But just the projected screen or the big screen in the background that kind of, you know, really gives that feel of, you know, you're on a train and you can see the trees going past, and the train, you know, the view of the train moves. So they're moving the train as the background kind of moves. It's just
Cool.
really well put together. So shout out to all the kids in Emmaus that had anything to do with that. Really well done. Absolute great performance. I think they're on for the rest of this weekend, which doesn't help anyone listening to this podcast. So that would be last weekend if you're listening next Wednesday. But really well done.
Well done, boys and girls. I told you that I was going to Sherbrooke Forest.
Yes.
I don't think a Sherbrooke Forest actually exists in Victoria.
I had no idea.
Sounds very mysterious, doesn't it?
Could.
But we went to Redwood Forest in Warburton last weekend.
Yes.
And man, I got out of the car. I thought there was going to be no one there. But as I arrived, it's just literally it's dirt road and what is it? What are the
Potholes.
Potholes in the road and whatnot. I think I need to buy a four-wheel drive. We go a lot of places where
Just
our
so
cars aren't supposed
he
to
can
go
through potholes.
But I got it. There was so many people there, and there was actually a food truck out there serving hot food and coffee, and he was pumping.
So you didn't discover this place by the sounds of it. A few other people have found it, and they invited a few food trucks. Sorry.
It's a really popular thing. But got out of the car, and man, I was literally blown away by just the height and the number of, and just this, I don't know, this sort of just this magical feeling of this forest. So it's a man-planted forest.
Yeah.
And I looked it up. It was planted in around the 1930s. So it's been growing for 90 years.
Wow.
Okay. And for one moment, I was wondering if this was a natural forest, but it's not. All the trees are just lined up perfectly, row after row after row after row. And it is just, you walk in there and there's just this calmness that comes over you. And it was magical. We just went walks through there. There's a large river that runs down the back end of the forest, and everyone just goes for. It kind of felt like back in COVID again. You know, people used to go for walks and just go out in nature.
Just
and so we took the boys, and they, man, as soon as they walked into that place, they were just this calmness. They were loving it. It was so good. We spent hours there. Took a picnic rug, had a picnic. So if you haven't been to Warburton, Redwood Forest, heading down to Warburton on a Sunday morning, grab a coffee down in Warburton shops and head down the forest.
So did this guy own the land and just one day decided to plant a bunch of trees, or is it government?
I had to Wikipedia it. There's no, you know, when you go to these places, there's a billboard, and you just read the history of what it is and why it's there and whatnot. But Nothing. So I had to Wikipedia it. I don't know. The trees came from California. They're Californian red.
Mate, that's California redwood. So I was telling you, so when we lived in the States, so up north coast of California, I can't remember the little town. Anyway, so it's quite a ways up, not quite Oregon, but most of the way. They got a massive redwood forest, and you can drive your big ass US SUV through the base of the stump of some of these trees.
Why did they cut the stumps out? Why don't they go around?
Well, some of them I think have grown. Because they're American.
Chop the tree down, in the way.
No, I think there are a couple where they've either caught on fire and the middle has burnt out, or they've just something's just happened naturally. It wasn't man-made. Like you can see it's kind of happened naturally.
Right.
And when you're up in it, I mean, you can see that it's kind of hollow in the middle.
Yeah.
And, like these trees just grow so large, and they grow for like hundreds of years.
Yeah, it's crazy.
Yeah.
I mean, these redwoods are only 90 years old. So
spring chickens.
That's my tip. Head down there on a weekend. It's absolutely beautiful. Spend a day there, have a picnic, enjoy with the family. Let's wrap up. Jump on YouTube, Spotify, Apple, Google, everywhere you get your podcasts.
Anywhere.
And just a reminder that on Spotify you can listen and watch, or if you just want to watch, you can jump on YouTube. YouTube shits me because if the phone turns off, the thing turns off.
Oh, yeah. What the hell's the deal with that?
Well, you got to pay for the premium, and it doesn't do that. Deb has subscribes to premium YouTube, so there's one user. I don't know anyone else that subscribes to YouTube Premium, so well done, Deb. All right, guys, we'll wrap up, and we'll see you next week.
Cheers, guys.
My name's Robert Baharian, and I'm the founder and CEO of Baharian Wealth Management, AFSL 526798. The information contained in this podcast by me, my colleague Matt Rigby, or any of our guests may include general advice and does not consider your personal circumstances. You should seek personal advice from a registered financial advisor who can consider whether the general advice is right for you.